Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull, your host to the world of commercial real estate. Thanks for being with us today. Well, we have a real treat for you. We have Dr. David Lynn joining us on Skype, and we're going to talk about his latest book. He's written, I think, 4 or 5 books. This book's called The Advisor's Guide to Commercial Real Estate Investments. And I've read this book. I recommend it. It's a great book. And we're going to get some highlights from David about this book. David, thanks for joining us today.
Well, thank you, Michael. It's good to be here.
Well, we appreciate it. And to get us started, David, who will get the most from this book?
Well, I'm hoping advisors, wealth advisors in this country that number in the hundreds of thousands who control trillions of dollars of wealth, and most of whom don't have very much in the way of alternatives or real estate in their portfolios.
Right. And real estate seems like a lot of wealth advisors are kind of looking at the stock market and things. So, why real estate? Why is real estate important to an investor's portfolio?
It's been a very well-performing asset class over the long term. In fact, it's been the best performing asset class in the last 15 and 20-year periods. It also produces the highest income with the lowest volatility and lowest correlations of any major asset class. So it has a lot of benefits, and it's been, frankly, underappreciated over the years. And the perception has been it's hard to access, it's hard to understand. So one of the main purposes of this book was to increase that understanding, to increase the education, the information, to make it easier to access and for advisors to learn and to convey that to their clients.
Well, you've done a good job with that. And, one of the things I've always seen, it seems like the rich people I know, at least, all have some real estate. And of course, some of them are very heavy, but even folks who aren't in real estate at all should have some amount of real estate in their portfolio. And then what about these hedge funds and pension funds? What do they allocate for real estate, and what's the trend there?
Good questions, Michael. You're right. I mean, traditionally, real estate has been seen as a major vehicle for wealth creation for a lot of people, and there are a lot of stories about how people became rich and retained their wealth with real estate. I mean, it's a very hot asset class right now. It's a perennial favorite, but it's very hot right now in terms of money that's considered to be pretty smart, like hedge funds. Private equity funds, but pension funds have long had real estate as a major part of the portfolio, and endowments are a good example of what's generally considered to be smarter money. Have always had a lot more of their investments in not only alternatives but in real estate. So it's where a lot of professional investors have been for a long period of time. And now advisors are recognizing that and wanting to do more in both public real estate, which are securities, as well as private real estate. But allocations have been unusually low for many advisors.
And tell us about advisors in general. So you have fee advisors and non-fee advisors. Tell us about that.
Yeah, the world generally is broken up into commission-based and then fee advisors. The difference is that commission-based advisors typically receive some sort of fee for putting the product on their platform. Fee-based typically does not. But both serve a purpose, and they're both probably around 50-50 in terms of the market share. So.
Okay. And what should these advisors and investors think about real estate and inflation, and the impact that inflation has on real estate versus the impact that inflation has on their other investments?
Right. I mean, we've been in a very low inflationary environment for quite some time, and so it hasn't been top of mind for a lot of people. But that could change, and in inflationary environments, usually hard asset classes like real estate do better than, say, cash or things that lose their value very quickly. Usually real estate appreciates at the rate of inflation or even higher, and that goes for the underlying property. Also, the rents are usually inflated too, so you pass that inflation along to your tenants. So it's been a very good inflationary hedge over the years.
Right, and you talk about the inflation figures haven't been that high, but if you look at real estate, because of a lack of new supply, we're really seeing rate increases and occupancy increases on most commercial real estate classes and most geographies across the country, aren't we?
Yeah, we really are. It's been a very low supply situation for many, many years, even over the past decade. So, we just didn't, this time around, did not feel the flames of, easy money and just reckless building. So it's really supplies at historically low levels, and it will take years to get back to just a normal level, let alone an oversupply. So we've got, lots of good tailwinds that are leading to, as you say, higher occupancies, higher rent growth, certainly above inflation, higher appreciation. Capital appreciation has been well above the rate of inflation, which is roughly 1.8 right now. For commercial property in good areas, it's been 4 to 6% per annum for many years.
Okay, and you mentioned that hedge funds and pension funds are tending to increase their allocation of real estate. We talked about the lack of new supply and what that's doing performance overall of commercial real estate. So how do you feel about commercial real estate and the relative values of commercial real estate over the next few years at least?
Well, there's a danger of asking a hammer how he feels about nails here. I feel pretty good about it. Yeah. There are always caveats, but I'll tell you that it's a well-performing asset class. Just to touch on a few things I've mentioned before, but it's been the highest returning asset class over a long period, the highest income, lowest volatility, lowest correlations. You combine that with the fact that there's very little supply, so it is about supply and demand. We'll continue to see very good appreciation. The main problem I see, potential problem, is not really the fundamentals of real estate, because they're good. The economy has been chugging along. We're occupying more buildings. Firms are more confident. They're taking more space. They're paying more rents. It's really about the popularity of it. And so there's been a lot of capital, particularly in large global gateway markets. And these are places like New York and San Francisco and Miami and Houston and Boston. There's been a lot of capital, not only from domestic investors, but from international investors. So that's pushed down the initial rate of return, called the cap rate, capitalization rate, and into an area where it hasn't been seen before. So almost record low in some places, record low cap rates in the more popular markets. But the U.S. is a very large market, so that's not true everywhere. And so there's still a lot of good buys to make. The spread, the difference between that initial return and the cost of capital, cost of debt capital, is still very good, very wide in a lot of markets. So, but the economy is something that no one really can foresee. We could go into another recession, but we're in pretty good shape because occupancy is very good. Firms have been very conservative about how they've taken space. And people in general have as well. It's been a very conservative ramp up, and leverage ratios are not crazy either. They've not gotten out of hand. So underwriting has been pretty good. Leverage ratios have been pretty conservative for the most part. And so if there is a recession, or I should say when there is a recession, I don't see us going into a lot of distress, and I don't see commercial real estate suffering as much as it did in the last go around, where things were over levered, where there were some poor underwriting, we had a mortgage crisis too in CMBS and RMBS, and we don't have that now.
Yeah, and I think that's one of the reasons that commercial real estate is a good investment, especially if you look at our current timing, right? Because we came out of a recession that really hurt commercial real estate. Now we're on a rebound. You talked about, the positive leverage. The cost of the debt in some cases is less than return if you're paying cash for the property. So, but maybe when you get in some of these gateway markets and you're getting these cap rates down to 3 or whatever, maybe you're not having that. But the other thing that you've mentioned here is the timing of the cycles and recessions. And we're going to take a short break. When we get back, I want to ask you some more about the timing, because it seems like I've had investors that I'll call when times are really good, and they'll say, Michael, appreciate you calling me, but I only buy it during a recession or recovery phase. So get back in touch with me at a different time in the cycle. And so we'll talk about it when we get back with Dr. David Lynn. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. We're talking with Dr. David Lynn about his latest book, The Advisor's Guide to Commercial Real Estate Investment. And if you're listening to the show on one of the 40 radio stations or one of the podcast channels, we're going to have some of the graphs on some of this information we're talking about at the show website, creshow.com. Of course, if you're watching it on YouTube, you're seeing them yourself. And before the break, David, we talked about the cycles, right? You have the recession, usually you have recovery and expansion and contraction. And what should advisors consider about real estate investing related to these cycles?
Well, the fact that they exist is very important. Some people try to deny that they will occur, but they certainly occur in real estate. Don't overpay. When we're building up to a cycle, when there's a lot of exuberance, irrational exuberance, and a lot of money being thrown around, the tendency is to rationalize and to say, well, it's a high price, it's a record high price, but gee, everyone else is doing it, and I can probably make money. Don't do that. Look at historical pricing, look at replacement cost, and do a very careful analysis of the cash flow without projecting into the future based upon wishes that you hope will happen, but make sure it's all realistic. And also, I think it's important to look at cycles as opportunities.
Right.
Down cycles are the best times to buy properties. So, it's well known. A lot of value investors, Warren Buffett, among many, who say, well, when everyone else is running for the exits, I'm watching a good movie, and if you keep a ahead and you do proper buying and you're looking for the long term, you can make great money buying at the bottom in real estate.
Yeah, that's a very good point. My non-real estate friends, I tell them if you're at a party and everyone's talking about how much real estate they're buying, you should be selling, right? And if everyone at the party is talking about how bad the real estate market is, you should probably be buying, right?
You really should be. Real estate, again, is a long-term asset class. They're not making it's hard to make supply, overnight. So, if you're buying in good areas, good property, good cash flow, good tenants, over the long run, you should do very well. And we've been talking about private real estate, but the same is true for public real estate. So REITs, what their value is based upon the underlying fundamentals of real property. So, there's even more fluctuation with respect to stock price and emotional swings and that sort of thing. So you can get some real values in REITs in the down part of the cycle. REITs were down last time at the bottom of the last recession, the Great Recession, some 70%. So they were 70% off their pricing. So if you bought at that big, very low point, you could have made a huge killing in REITs, and a lot of people did. So REITs have been a very well performing asset class over the last few years.
Yeah, that's a very good point. And when you talk about cycles too, and you look at we're probably in a recovery cycle in some parts or some buildings, some property types and areas, but we're in an expansion phase in others. So where you might be looking at apartments in the major markets, obviously we're in a big expansion, but you might be in a smaller market or a different property sector. You might still be in a recovery section, right?
Well, certainly, Michael, that's a very great point. That real estate is not monolithic. People think of the stock market. There's a national stock market, there's a national bond market. Real estate is very location specific and very idiosyncratic, with a lot of different, with respect to a lot of different factors of the building type, the locale, the city, but even the submarket determine a lot of how the investment behaves. So yeah, you could have a horrible market, but a great location, great city, great submarket, and great building. And so that's the beauty of real estate. You can find, where you want to play, and you can find a great performing property in a bad market. And conversely too, when everything's up and up, you can still do badly in real estate if you don't do the things we just covered. Consider those things. But it's a very diverse and huge market in the U.S. that we have. We're very fortunate to be able to pick various types of markets, various types of drivers of those markets. Tenant quality is another factor that determines a lot of value, and then the building, the quality of the building, the type of the building, the age of the building, and those are really idiosyncratic factors. And if you do your homework, you can do much better than the average.
Yeah, another thing that I like about real estate too is you're not as impacted by the overall market as you might be impacted by the operator, right? By the management, by the asset management. So, paying attention to who the sponsor is. If you're doing group investing, that's real important to look at the sponsor, their track record, and how they're handling the property, right?
Oh, absolutely. I mean, there's a good chapter in the book called Choosing the Advisor, and it goes through everything that a wealth advisor should go through in choosing a real estate advisor. And it's a pretty comprehensive due diligence checklist. And but yeah, you could have a great property in a great market, but a terrible operator, terrible manager. And so you really have to be very careful about their capability, their track record, their personnel, their systems. All that is very important. So I recommend taking a look at that. If you are going to do direct investing, you'd be very careful with who's actually managing that property, who's investing that property.
Yeah.
And just make sure that they answer all the questions to your satisfaction, and make sure that they're very transparent and open. If they're not, then I think that raises red flags.
Yeah, that's a good point. That's one of the things that I've always enjoyed doing as a broker when I'm helping them. A group investment firm, fund, or an individual going to individual properties is finding properties that can be managed differently, you can be operated better, and seeing opportunities. And one of the things that you've mentioned earlier is diversification. So that is really one of the benefits of commercial real estate. So even inside of commercial real estate, right, you have all the different geographic areas and property types. And I know as CEO of your new fund, Everest High Income Property, is a diversification something you guys are looking at there?
Absolutely. I mean, diversification is the free lunch where you can get higher returns for lower risk, which sounds hard to believe, but that is the way to do it. It's been proven by many people. Harry Markowitz proved in the 1950s that you can achieve better returns and lower risk, lower volatility with diversification. So real estate, you have the advantage of doing that by geography, by market, by property type. And we say property type, we mean office, industrial, retail, multifamily, and other, and hotel, and then other niche property types. So you've got a big range of levers that you can use for diversification. And you can also diversify by lease type, net lease or otherwise, or lease duration or credit quality of your tenants. And so that's what we try to do at Everest High Income Property, and it's just good practice. You should not put all of your eggs in one basket, because you never know what will happen to that basket. And some people will say, well, just pick a great basket. But I've seen regions behave radically different economically. The Bay Area, where I happen to be right now, is a great.
And I want to hear some more about this. We're going to look at risk. We're going to look at different ways to invest. We'll be right back. This is the Commercial Real Estate Show.
The Commercial Real Estate Show is brought to you in part by Florida International University. With FIU's Fast Track system, you can earn your master's in real estate in just 10 months without interrupting your career. Visit FIUonline.com to learn more. That's FIUonline.com.
Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking with David Lynn. He is CEO of Everest High Income Property. He's also the author of this book, The Advisor's Guide to Commercial Real Estate Investment. And if you're watching on YouTube, you see that I'm doing the Vanna White thing here, showing off the book. And David, the Fed is telling us that interest rates are going to rise, and maybe they're going to rise slowly. What should advisors and investors think about related to commercial real estate investing and the impact of rising interest rates?
They've been incredibly low for an incredibly long time, longer than any one of us ever thought. So we've been very fortunate. It doesn't appear that they'll rise dramatically. It'll be gradual. It'll still be very beneficial for real estate, quite frankly. So. It will reduce the spread. The margin cap rates might rise a bit in response to that, but I don't think it'll lead to a massive devaluation of real estate at all, because I just don't see the Fed going crazy with rising interest. There's no real need to raise rates. Usually the impetus is because of inflation. And we don't have a problem with inflation at all. We might have a problem with deflation. So there really isn't a dramatic problem either way. Having said that, it's just a very benign environment. So rates will rise, but it won't certainly kill the enthusiasm for real estate, and the returns will still be relatively very attractive compared to other asset classes.
Right. And the interest rates, even if they rise a couple full percentage points, they'll still be historically just extremely low and good for real estate. And, also one might argue that if rates go up a little bit, that people feel like we're in a more normal environment and maybe be willing to expand and invest and do the things that will help the economy, right?
Yeah, that's a good point. Rising rates indicate a better, healthier economy, which is good for all of us and good for real estate. It means that corporates, firms, people will be taking more space. They'll be buying more. They'll be renting apartments more. They'll be just doing more economic activity, which will be beneficial for real estate.
Yeah, and I think if we look back from 5 years from now, let's say, and we look back at today, I think we also may wish we had locked in some long-term rates and bought some commercial real estate. One of the things I think that investors and advisors are concerned about in commercial real estate is risk, right? So what should these advisors consider related to risk in commercial real estate?
Well, you touched on one of the, interest rates. So try to lock in long-term rates on debt, now, because the rates are very attractive, and you're locking in profits basically if you can do that. Be very careful with your underwriting and be very conservative about how you look at investments, how you look at cash flows. Be very careful with projections, and evaluate the property, the tenant quality, and the sponsor is very important. So the person or company investing for you, managing the property, go through that checklist, and don't overpay. It's probably the biggest risk in any part of the market. There's a tendency for people to get wrapped up in the thinking of crowds. Sometimes the delusion of crowds that it becomes this sort of rationalization. Since he paid a high price, I can pay a high price, and he got away with it, and he made money, then I can make money, and pretty soon it's a mania. It's kind of a tulip mania. So don't go into that stampede of irrationality, and just keep a cool head and make sure your pricing is in line with historical metrics for pricing, and you should be okay.
Those are good points, David. And, so when you talked about allocation too, right? So you don't want to put all your money in real estate or into one deal for sure. And you talked about checking out the sponsor, right? How are these properties managed? Or if you're buying it privately yourself, how are you handling it, right? And have a plan. I think one of the things that some people forget about too when they're investing in real estate is you really should have an exit plan when you get into that investment in the beginning, how you're getting out, right?
Very good point. I mean, you should have a plan for the property, and what you'll do, the capital expenditure that you need to put into it, your horizon, the duration that you'll keep the investment, and when to get out. So you should be very disciplined about that. And a property plan for each property is a good idea. And but also bear in mind that investing in property, investing in real estate, is not a short-term proposition. So to harvest real gains, usually you've got to be in a property or in a REIT for many years, and that's more like the 4 to 5 year period. So it's different from stocks, or some other investments. It should be seen as a long-term proposition. And sometimes in the short term, people panic. That's another risk. They look at the markets, they hear bad news about the economy, values could be going down, rents could be going down, vacancies could be going up, and then they panic.
And get out much too soon. Well, stay tuned. We're going to have more from David Lynn about real estate investments and the guide to advisors. I'm Michael Bull. This is the Commercial Real Estate Show. Xceligent, the resource professionals like CCIMs, CBRE, JLL, Colliers, and Bull Realty use for market intelligence. Commercial Search is the site to market and find available properties to buy, sell, or lease all over the country. Visit commercialsearch.com. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Remember, don't miss a show of special interest to you. Sign up for a once-a-week email announcing the show topic at CREshow.com. Well, today we're talking with Dr. David Lynn about his latest book, The Advisor's Guide to Commercial Real Estate Investment. And David, I think advisors typically think of a couple ways, main ways, right, to invest in real estate. What is the easiest way for investors to invest through their wealth advisor?
Sure, Michael. The easiest way is to just buy REITs, which are publicly traded real estate securities, and they're listed on the exchanges, and you simply go in and do your homework and buy shares. And many of those REITs will deliver a dividend, which is very, very good for portfolios. So the dividend tends to be higher than average than other investments. Right now, it's about 3.5% on average for REITs, which in this environment is pretty respectable.
Right, and when you look at the returns that REITs have had overall compared to the stock market, they've done pretty well, haven't they?
They've done very well, yeah. They're one of the best performing investments over the last 5 years, 6 years now, and they had a huge downturn in the Great Recession, but they came back very, very strongly. And so that's a great way. It's a great way, very easy, very tradable, very liquid. Then the other way is through private real estate. So these are private equity funds. They're private REITs. They're public non-traded REITs out there. They're individual investments. So those are not as liquid. They usually have a lockup. They're usually investing in a property or a pool of properties. So you really have to watch the fees and pay much greater attention to the operator. And it's a bigger universe, and it's many of the operators are much smaller. So that takes a little bit more careful due diligence, more careful underwriting. Our own fund is very transparent, low fee, diversified, higher income. About a 7.5 current income, and we apply professional practices, institutional practices to what we do. But it's a big wide range out there.
Tell our listeners and advisors the main differences between a private REIT and a REIT they can buy on the stock market.
Yeah, private there are kind of two types of REITs: a private non-traded REIT and a public non-traded REIT. Mm-hmm. So private non-traded REITs are almost like private equity funds,
mm-hmm.
A GPLP format. So not too much different really, except that you trade in shares, not properties. Whereas in a private private equity fund, you're trading in percentages of the fund. But a public non-traded REIT is actually a public company. It's just not traded on an exchange, and those have come under fire recently for high fees, high commissions, and certain management practices. So they're not quite as popular right now. But private real estate is actually performing very well, and has benefits of lower volatility, lower correlations. It's really an amazing. And if you're constructing a portfolio, those are huge benefits to have low correlations and even negative correlations in some cases. So, but it tends to be a little bit harder to access. You have to do a bit more homework.
And let's talk about that homework for a moment. So if you're an investor or an advisor, how much due diligence should you do related to the REIT managers or the sponsors that you're investing in a private investment?
A lot of it is word of mouth. A lot of it is reputation. But be careful there. I mean, a lot of people, want that route in investing with Madoff. So, if smart people, smart funds have invested with an operator or fund, that's usually a good sign. But I wouldn't stop there. I'd do your own homework in terms of evaluating the properties, looking at the actual cash flows, the tenant quality, the building quality, the diversification, the age of buildings, and make sure that they're not projecting anything that is real current cash flow. And those are some of the things to do. And there's a good checklist in one of the chapters in the book.
All right, that's great. And you've run some large funds that have controlled a lot of real estate around the U.S. and some other countries. So what's your outlook on some of the various property types right now and some of the sectors that folks can invest in?
At the risk of sounding too positive, a lot of it is really good right now. Mm-hmm. And, so I'm not going to sound very negative at all. Multifamily, which is apartments, are doing very well. Great demand, great demographics there. Retail doing much better, recovering, probably the weakest sector, but recovering. Faces competitive threats from the internet. More people are buying online, and there are a lot of older centers out there which don't have a lot of tenant appeal. And so it's kind of winners or losers when it comes to real estate, retail real estate. Office is recovering nicely. Just very little has been built over the years, and despite what people have said, not everybody wants to work at home or in a cafe, and so particularly in the global gateway markets, we see much stronger office demand. Industrial. The economy has been chugging along, so good industrial demand, particularly in gateway and port cities where there are major distribution hubs. So industrial has done very well. And hotels, hospitality, people are traveling more. They're traveling more for business and leisure. So great fundamentals there. And in every asset class, really there isn't enough product. So multifamily might be an issue where there is a lot of product in a few markets. But for the most part, nationwide, there's an insufficient supply of multifamily as well. So, we face a combination of very positive events, and so I'd like to be negative, but I really can't be. The most negative is that it's becoming very popular.
Yeah.
Prices are going very high.
Yeah, and property is getting scarce. Well, stay with us. We'll have more from Dr. David Lynn. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by RealNex, providing a comprehensive suite of powerful commercial real estate tools at an incredibly low cost. Visit realnex.com. That's REALNEX. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Today we're interviewing Dr. David Lynn about his book, The Advisor's Guide to Commercial Real Estate Investment. And David, if we have advisors, we have investors out there, they're interested in commercial real estate now. They understand where we are in the cycle. They understand the lack of new supply. And I think a lot of people really understand and feel really good about commercial real estate. But, the confused mind says no. If you want more information and you don't have it, you're a little afraid to jump in the water, right? Where can advisors get more information about commercial real estate? And before you answer that, I would say they should read this book, Advisor's Guide to Commercial Real Estate Investment. In fact, we've put a link on the homepage of our website. You can click right there and buy the book in about 10 seconds. So go to seriesshow.com. Where else, David, some advisors, investors get information?
Well, you took the words right out of my mouth. It's a very comprehensive book. It's written, I think, in very plain language, very clear, lots of information, lots of data, and from a variety of experts, leading experts in commercial real estate. There's also your show, which is a fountain of good information, a lot of wisdom from the people you interview on your show. So it's a great resource. I'd say, there are industry groups like NACREIF, NAREIT, ICSC, the ULI, the Counselors of Real Estate. So there are many that if you go to those websites, maybe we can provide those links afterwards. There's a lot of information on those websites, and you can learn from. And then there are traditional textbooks about investing in real estate, kind of the fundamentals of it from a more basic academic point of view, and those are really useful too. But try to shy away from people who are like talking about deals and bragging, and won't mention any names, but you know them. They're colorful TV personalities. Can't really learn too much about that. It's a very serious business. There are a lot of technical details and components to it that you should learn, and it's about doing careful analysis, careful research, and having the right information, being armed with the right information, and I think the book does a good job with that.
Yeah, it certainly does, and it's interesting that it is kind of considered a niche market, but commercial real estate's a huge part of the GDP here, and it's a great investment vehicle. And so do reach out and get more information if your clients, or if you're the client and you're not investing in real estate, look at it. What about some closing tips, David, for advisors, if you will, first that are interested in getting their investors more involved in real estate?
I think you have to educate yourself as an advisor and then educate your client. So again, the book is a great resource for that. I'd say, if it's private investments, individual properties or portfolios, take your time, leg into it, and don't invest everything in one property. Diversify, and diversify by location, by region, by economy, by property type. And be very careful about what you pay for the property. So that's the initial cap rate, which is don't buy a cap rate that's too low, that initial rate of return that's too low. And there are metrics around this, and some of those are in the book. And be careful about the actual price itself. Is it a peak price? Is it below peak pricing? Where is it? Where does it fall in the whole range of data over the years? Is how much above or below is it with respect to replacement costs, the actual cost to replace that building? You should be trying to buy at or below replacement cost, but in many markets you can't do that. But the point is just try not to overpay.
Yeah.
And try not to be wrapped up in exuberance in the crowd.
Yeah, that's great. Well, David, thanks for joining us today. We sure appreciate you being on the show.
Thank you, Michael.
Well, stay tuned. Join us next week. We're going to have a great show on the multifamily market. As David mentioned, it's been a great market. Is it still time to buy? Is it still time to get in? We'll find out next week. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.